Right now, somewhere in this country, a renter's staring at their phone reading an email from the property manager, and it's got the 4 words, "Every Aussie tenant dreads. Your rent is increasing." Not by $10, not by 20, $50 a week. That's over $2,500 a year, gone before you've bought a single loaf of bread or paid a power bill. And here's the bit that should really get under your skin. We were told this wasn't supposed to happen. Not like this. Not this fast. In this video, I want to walk you through exactly what's happening to rents across Australia right now, using the real current numbers from Domain, PropTrack, and Cotality. That's CoreLogic's new name, if you haven't caught up, and break down what it actually means depending on whether you're renting, trying to buy your first place, or sitting on an investment property. Because once you get past the headlines and the political spin, the picture is a fair bit more confronting than anyone in Canberra let on. Let's start with what we were told. Back on budget night in May, Treasurer Jim Chalmers announced the government was pulling negative gearing away from established properties bought after that night and swapping the 50% capital gains tax discount for cost-based indexation instead. New build properties keep the old rules. Anyone who already owned before budget night keeps the old rules too. The logic, on paper, is straightforward. Nudge investors toward funding new housing instead of scooping up existing homes, and over time, that eases pressure on renters. Treasury's own modelling said the rent impact would be tiny, less than $2 a week, spread out over an entire decade, barely worth mentioning on paper. But we've heard minimal impact before. When the government threw open the 5% deposit scheme to every first home buyer back in October last year, Treasury reckoned it'd lift national home values by about 0.6% over 6 years. Real world, national home values jumped 1.1% in that first month alone, the fastest monthly gain since 2023, with nearly 6,000 first home buyer guarantees issued in October and almost 50% more people using the scheme than the month before it expanded. Different policy, different market conditions, sure. But the pattern rhymes. Treasury's model is one thing. What actually happens once real people start reacting to real incentives is something else entirely. So what's actually happening on the ground with rents right now? Let's get into the real data, because this is where it starts to sting. Domain's March quarter figures have Sydney house rents sitting at a record $800 a week and units at a record $750. Technically, that's flat on the quarter before, the first pause in 2 years, but don't let that fool you, because in the same report, Sydney's vacancy rate dropped to 0.8%. That's the tightest rental market on record. Showing up at the exact same time, rents supposedly paused. Read between the lines, landlords don't need to keep pushing when they're already sitting at maximum leverage. Then there's Cotality, the old CoreLogic, and their numbers put Sydney's median rent even higher at $824 a week, up 5.9% on a year ago. Perth and Brisbane are running hotter again, both around 6.7% annual growth. And here's the number that really tells the story. Over the past 5 years, rent growth has added roughly $200 a week to what the typical Aussie household now hands over. $200 every single week. That's not a wobble in the data. That's a structural shift in how much of your pay goes straight toward a roof over your head. Then PropTrack. National rents just hit a record, up over 6% in a year, with capital city rents now $40 a week higher than they were 12 months ago. 3 separate research houses, 3 different methodologies. The exact same story every time. Rents climbing, listings nowhere to be found, and tenants absorbing all of it. Now here's a question worth sitting with for a second. If vacancy rates are already under 2% in every single capital city right now, before the negative gearing changes have even formally kicked in from mid-2027, what happens once they actually bite? Stick around, because we're about to unpack the mechanism, and it's honestly a bit alarming. Quick one before we keep moving. Drop a comment below and tell us what your rent has actually gone up by this year and which city you're renting in. I read every single one, and lately some of the numbers coming out of Perth and Brisbane have been wild. Here's the mechanism. Rental listings nationally are sitting around 18% below the 5-year average. In Sydney, it's worse, down more than 27%. Melbourne's down around 21%, with a national vacancy rate hovering around 1.5%. and every single capital city under 2% tenants have basically zero negotiating power left. Say no to a rent increase, and there's a queue of people right behind you who'll say yes without blinking. Negative gearing used to work like a shock absorber for landlords if the weekly numbers didn't stack up. Part of that gap got clawed back at tax time. Take that away on established properties and landlords have fewer ways to absorb a loss. In a well-supplied market, competition would cap what they could pass on to tenants. In a market this tight, they can and plenty will. To be fair, this isn't just about one policy. Interest rates matter. The Reserve Bank's cash rate is sitting at 4.35% right now, after 3 hikes earlier this year tied to the energy price shock out of the Middle East. Migration matters, construction costs and approval delays matter too. But strip incentives out of a market that's already starved of supply, and nobody serious should be shocked when renters feel it first. So, is this temporary? In theory, maybe. If investors genuinely shift toward funding new builds instead of buying up existing homes, supply eventually improves and pressure eases. Not an irrational theory. The problem is time. The National Housing Accord's target is 1.2 million new homes by mid-2029. Right now, the country's already well over 100,000 homes behind pace, and catching up would mean completing homes at a rate we haven't hit once since the Accord began. Construction costs are still elevated, approvals are still slow, and migration hasn't stopped adding demand. So even if the long-term logic checks out eventually, the next couple of years are going to hurt regardless. So what does this actually mean depending on where you sit? If you're renting, the honest truth is the power sits with your landlord right now. If rent keeps outpacing your income, you're not really choosing whether to pay more, you're choosing what to give up instead. Moving further out, a longer commute, a flatmate you didn't really want. Not a comforting answer, but it's the real one. If you're a first home buyer, remember, a mortgage isn't a bet on the next 6 months. It's usually a 15 to 30-year decision. Governments will keep changing policy. Rates will go up and come back down. What doesn't change is that this country has consistently added people faster than it's added homes. Waiting for the perfect moment has cost more buyers than it's ever saved them. And if you're an investor, the uncomfortable truth is that as long as Australia is running a genuine housing shortage, well-located property is still likely to hold up as an asset class, policy uncertainty and all. That's not financial advice, just where the current data points. So here's the real takeaway. This was never just about one line in a budget speech or one Treasury spreadsheet. It's a reminder that when you change the incentives in a market that's already short on homes, the pressure doesn't just disappear. It gets passed on. And right now, week after week, a huge chunk of that pressure is landing directly on renters in real dollars out of real pay packets. If this helped you understand what's actually going on with rent in this country, smash the like button so more Aussies see it. If you're not subscribed yet, get amongst it. And if you want more straight-up data-backed breakdowns on property and policy, hit that notification bell. Thanks for watching, and I'll catch you in the next one.